You are welcome again to today's session. We want to look at how to trade small accounts. All right, how do you trade small accounts and record huge success? That's what we want to look at. Many people have erroneously thought that you must deposit a reasonable amount of money before you can make a decent profit. If you are not greedy, you can as well deposit small amount of money, and over a couple of weeks, you can make incredible return from the amount you have deposited, no matter how small it is. And from there, you can take off the account and move it to the next level. The tricks involved is not something that is difficult. But the question is, do we have the right psychology to handle the trades as they come? If we see little retracement, don't we panic and close off the trade? How do we handle it if we get a loss? How does that loss resonate in our hearing? So these are a whole lot of stuff that goes into handling a small account. All right? But there are 2 or 3 things you should know and understand clearly when you are handling a small account. 3 things essentially, 2 or 3. The third might not be too significant, but I might just add it for you. Number one thing you must pay attention to is that you must have a good strategy. A good strategy. And you know, a strategy cannot be said to be good if it does not have a good entry point, a good exit point, all right, and a good trade and risk management strategy. If you don't have all these 3, there is no way I can agree with you that your strategy is good. Your strategy is good only if it has an entry point that has a very good risk to reward. Only if that strategy can tell you enough, it is time for you to take your profit and go. And that strategy can also tell you that at so point, your trade is due for a break-even. All right? At so point, your trade is due for break-even. When you have all this, we know you have a good strategy. And any strategy that have all these parameters that I have listed for you will surely return consistent profit in the market. Okay? And last but not the least, that your strategy that is branded as a good strategy must be capable of telling you that your analysis is wrong. If the market goes against you in such a way that it invalidates your setup, that strategy must tell you. All right? You must see it clearly that, oh, this trade is going to hit stop loss. It's going to hit stop loss because it has invalidated my setup. But when you don't have all this lining up for you, you cannot tell me you have a good strategy. And to return consistent profit will not just happen. Now, for instance, if you have an impulse like this, and you have a regular flat like this, you have seen that this is a regular flat. After this regular flat, what do you expect? You expect this swing to the upside. In as much as this is A, this is B, this is C. All right? This might be big A. Then this three-wave correction, A, B, C, will be B, with B, and then you are expecting this with C to break this top. You already know that this is the setup. This is what we are expecting, guys. And your forecast is saying that you need a regular flat here because B does not break the beginning of A. And C is expected not to break the end of small a here for it to be a regular flat. And you know, after this has happened, the next thing that will happen is a move to the upside. Okay, now, if this move is happening at London session and it's happening around 9, 1 hour to market open, or 10 or 2 hours to market open, then you ask yourself, this move is happening at what time? London session. What time of London session? 1 hour to 2 hours into market open. Then you know you are in the middle of liquidity. You are in the middle of what? Liquidity. It means there is adequate volume at that point in time to drive this move to the upside. Then you will notice that from here to here might just be 10 pips. 10 pips. And you know that if this level is invalidated, then your regular flat assumption is invalidated. If that is the case, what you do is to keep your stop loss just 5 pips below this level of invalidation area. Then the total pips from here to here, 5 pips. From here to where the market is, 5 pips. Keep 10 pips stop loss. So if I have a $50 account, guys, and I want to maintain a 10 pips stop loss, then I ask myself, how much am I willing to risk from my $50 account? I say, okay, I'm willing to risk $10 because I must have seen that with my strategy, I don't take 5 trades and lose all in a row. I can lose 1 or 2, but the 3 I will win, I will probably get 1 to 3, 1 to 4, 1 to 5 risk to reward. So if that is the case, the first trade I take, 10 pips, risking $10, and the trade move to this level. The trade has given me 20 pips. As soon as the trade gives me 20 pips and I'm running in $10 profit, what do? I move my stop loss from here, I move it to this level, break even. In such a way that even if this market retraces to form another structure, I lose nothing. And if this trade push to the upside and get to my target, I close it. In most cases, it can give you as much as 70 or 80 pips. 80 pips. So from this setup that I was able to forecast using Elliott wave theory, you will see that I have risked just $10. Okay, I've risked $10 in 2 positions, 0.05 in 2 positions. That's what is going to happen here because we are risking 10 pips. If it's more than 10 pips, it has gone below our invalidation area. Okay, that 10 pips, 0.05 is $5. Another 10 pips, 0.05 is $5. So I'm risking in two positions overall, I'm risking $10 and I have made 80 pips. I have made $40. $40. That's what I've made in two positions, 80 pips. Risking 10, getting 80. That is 1 to 8 risk to reward. So by the time I add it, 40, I add it to my $50. I get what? I get $130 in one trade. What is making me to be able to get this? Because number one, I'm able to determine the structure of the market, which says that after an impulse, there must be correction. And that correction should most of the time be a three-wave structure. And after the three-wave structure has formed, I know we have to move to the upside. And the three-wave structure that form here, I can identify it as a regular flat. And a regular flat is a kind of flat where wave B does not break the beginning of wave A to the upside, and then wave C here does not break the end of wave A. Once a regular flat has formed, I know I am to the upside. I just wait a little and see an impulse forming. I want to see an impulse, a very strong move here. As soon as I get a strong move here, I know that there is confirmation to the setup that I have laid down. And the next thing for me to do is to just look for invalidation area, just 5 pips below the level, the completion of the of the correction, which is a flat, irregular flat corrective structure. And from there, I can pull the trigger, risking only 10 pips, 5 pips, in this case, 5 pips into the current market price and 5 pips below the end of correction, which I recognize as the invalidation area. Okay? This is how you go about it. All right? Again, let's go and cite another example. Let's look for another example. Assuming you have a structure this way, assuming you have, let's look for bearish market, you have impulse, and then you have 1, 2, 3, 4, 5. You have, let's say, assuming you have this triangle, okay? And after the 5th wave, you know you are going to have a move to the downside, okay? Now, you know that this is wave A of a triangle, this is wave B of a triangle, this is wave C of a triangle, this is wave D of a triangle, and this is wave E. You have known this, and you know that a triangle is made up of 5 wave structure, and the last wave of a triangle is wave E, which has possibility of overshooting its upper resistance level. So once this is done, and you know that the next move is to the downside, if you pull the trigger here, once you see a bearish move here, if you pull the trigger here, and you see you are able to determine the invalidation area here, if the distance between here and here is 15 pips, remember that our account has grown to where? Our account has grown to 130. Now we can afford to risk $30 in this trade. It will be looking as if you are risking big, but because you are paying attention to your trades, you are paying attention to it, you will discover that you will be on top. Okay? Now let's assume that here You now risk 15 pips, and you want to risk $30, 15 pips. You can look at it, okay, here you can do 0.2, 0.2, 0.2. If you do 0.2 here, 15, 15 pips stop loss will give you $30 loss. Okay, $30 loss. And once it moves, you wait. You now wait for either London session or New York session. Either London session or New York session. Wait, because that is when you are going to have liquidity in the market. You do not want to trade a small account where you are going to be a bit over risk in an Asian session that is full of consolidation. You want to be sure that the market will impulse away from your entry point before you can take that decision. All right? Now, when you have this set up this way, and you know you are going to proceed to the downside, you need to wait for London session or New York session to find out what the market is saying at that moment. So when you wait, and let's say you are about New York session is about opening, you quickly go to the new session of Forex Factory to go and check what news, what fundamental may likely assist you to push the price lower at this level. You want to find out which fundamentals can help you to achieve that. Okay? You have to find out. So if you are able to, get a piece of news that will support this pair falling, then that will give additional confidence to you that the trade is going to push to the downside. So what do? You pull the trigger, 0.2. As soon as you move 5 to 6 pips, say it's too early, move stop loss. Don't move it to entry yet. You can reduce it from 30 pips to 15 pips. As soon as it moves away by 5 to 10 pips, just adjust the stop loss from 15 pips, adjust it to 10 pips. What is the implication of this decision you have just taken? The implication is that you have reduced your risk from 15 pips, which is equal of 0.2, which is equivalent to $30 risk. You have reduced it to 10 pips, which is now equal to what? $20. So from your $130, you have risked $30 before, but you are now risking $20. So if you further move away and give you about 30 pips, just move entry to break even. As soon as you move entry to break even, let it continue to push and impulse away. At the end of the day, you might get 70 to 80 pips or 100 pips. Let's say you get 100 pips, because when you have a triangle of this size and it's breaking down to the downside, it should give you 100 pips. Okay? So when it gives you 100 pips, remember, you are using 0.2 lot. 0.2 lot times 100 pips, that is $200. And this $200, if you add it to your initial $130, it will give you what? 200 and what? $330. Can you see? This is how we do it every time. You wait again. You could get, at this stage, you could be trading 2 or 3 pairs at the same time. When you started, you were trading only one pair. The essence of trading one pair is that so that if anything happens in the market and everything scatter, you will not lose your money. You are trading one pair. But as soon as you get to 330, your account is growing. Don't over celebrate yet. Just increase it to 2 pairs. 2 pairs on your MT4 at the same time. All right? 2 setup, place it. Decide. This 330, maybe at this stage, I want to risk $50 out of it. Maybe on the 2 trades, each of the trades, $25 each. And maybe when you go in, you now discover that you lost the trade. Unfortunately, something happened, your analysis was wrong, and you lost the trade. The one thing you will tell yourself is that it is not possible to win everything. You are going to be winning some, and you are going to be losing some. So what do? You minus $50 from 330, you are left with what? 280. All right? You are left with 280. That's still fine. At this stage that you have lost a trade, what you do is that you encourage yourself, go back to the drawing board, check the trade that you just lost, find out the reason why you lost the trade. Is it that there are some fundamental news that went against you? Is it that you did not analyze well? Is it that you made mistake in your analysis? When you find out all these reasons and why you lost the trade, you can now correct yourself and make sure that such mistake do not arise in any other setup you are going to be taking. All right? So this is how you do it. Again, there are people who understand that in most cases, it looks as if I stack. All right? I do not stack. If you see I stack, you are right, because by virtue of what you see on the MT4, it is stacking. All right? But the way I do it is special. The initial position I enter is probably, let's say, 2 positions. First enter 2 positions. Okay? I first enter 2 positions. After I enter 2 positions, and the 2 positions have impulsed away, they have impulsed away from my direction. Let's clean up all this, and let me explain that to you properly. Okay? Let's assume that we have impulse, an expanded flat, and we are going on continuation. You have impulse here, you have correction here, and then you want to buy this to the upside. So if you enter here, let's assume you enter here, put your stop loss here, 20 pips. Okay? 20 pips. And remember, your account now at the moment is, our account is what? $280. Because we move it to 330 and we lost $50. We had $280. Now, you first make a decision that out of these $280, you are willing to let go how much. Remember, it can no longer be 50 again. You risked 50 the other time, you lost it, you have to reduce your risk now. So let's say you want to let go $30. That is the first decision you will make as a trader. And that is why if you lose it, it's not going to pay you, because you have already decided before you enter the trade that that's what you are ready to throw away. Peradventure, you lose the trade. Okay? Now, watch. The stop loss. The next question you are going to ask yourself is that where is the stop loss level? How many pips is the stop loss? You discover your stop loss is what? 20 pips. What lot size do I enter in such a way that if I lose the trade, I lose $30? This is what? 0.15 lot. 0.15. That is the lot size you will go in. If you use this lot size with 20 pips stop loss, if you lose the trade, you're going to lose $30 straight. So now, you can therefore to enter this trade in 2 positions if you wish. I will tell you the advantage of entry two position. That is 0 point what? 0.075 in two positions. If you enter this in two positions, if you lose the two trades, you're going to be losing $30. All right? So as soon as you enter the trade, make sure that this trade, you're going to enter it at the tick of London session or New York session, where there is adequate liquidity in the system. All right? The essence of making sure that there is adequate liquidity in the system before you get in is to ensure that as soon as the market impulse away from your entry price, it does not have opportunity to get back, to break you out or to take you out. Okay? That is the essence of waiting to get adequate liquidity before you get in. All right? So now, as you enter two positions, it impulse away 5 pips, 6 pips, 10 pips to your entry. What do? Just move stop loss, because you are having one ambition, and that ambition is to add another position. And you don't want the market to move away from your entry price too much before you add this position, so that you can have a better risk to reward. So what you do is that as soon as it moves 10 pips, break even, move your stop loss to entry point. As soon as you move it to entry point, you have protected these two. But remember, what you have decided to risk is $30. But as soon as you have protected these two trades that are in profit, enter another two positions of 0.15, 0.7, 0.075, and 0.075. Two positions. Enter it again. As soon as you enter buy on these two positions, just put the stop loss 5 pips below your break even of the other two positions. 5 pips. Remember, if you put it 5 pips below the break even level, you are going to reach 15 pips, not even up to 20 pips. In that case, you are now having 4 trades running. And overall, out of the 4 trades, you are not even risking $30 again, because you are not maintaining the previous stop loss level, because the market has impulsed away from your entry zone. You are now risking $20. You are risking $20 and 15 pips. You are risking 15 pips now, because we were doing 20 pips before, but as soon as the market impulse away, we reduce it to 15 pips. And remember, the first two positions you took, you have break even. You have moved your stop loss to entry point. Those ones are risk-free. And the remaining two positions, you have entered the trade and you have put your stop loss 15 pips. 15 pips. You are risking not even $30 again. You are risking $20. And if there is true liquidity in the system and all impulse away, then up to 20 pips. If the second position impulse away 20 pips, it means that the first set of position must have made 30 pips, 30 pips each. Then you break even the second position. It means all the positions are now risk-free. Remember that you have identified this as a corrective structure, and you want this to at least break this top. As soon as you break this top, you don't even waste time. You now look at it. How many pips? How many pips do you get here? Maybe 60 pips. 60 pips. When you get to these 60 pips, what do? The first set of position you enter. The first set of position you enter. Maybe those ones, 60 pips, those one has given you 60 pips, 0.75, 0.75. Probably it must have given you $35. Let's say, no, 60 pips, let's say $40. Okay? Let's say $40. That is 80. The first two positions have given you $80. Okay? And the second position, remember, the second positions, you enter it 10 pips. So the other one will make 10 pips above this one. Okay? So let's say this other one has done 50 pips. Those 50 pips will be like 30, $33. So that's another 60. For instance, let's say another $60. So what you do is that the first position, the first set of position, you close it when you get to this height. You close it. And after you close it, if it's still moving, you now move your break even, you move it from here, and of the remaining two positions, you move it to this place. So that even if this market should come, it's going to take you out in big profits. It will take you out in what? In big profits. If you like also, you can decide to close all 4 positions in 60 pips for 2 positions and 50 pips for what? For the other 2 positions. See, $60 plus $80 is another $140. Okay? This $140, by the time you add it to your $280, okay, to give you what? To give you 204. You are now in $420. Can you see how we have been able to move our $50 or $70 to $480 with just few trades? You can see from the 3 examples I have given you now that what you require in order to have a good result are essentially good strategy, a winning strategy, and not only a winning strategy, a perfect trade and money management strategy. You can't be trading with a strategy that gives you 70 pips, 80 pips stop loss, and you want to tell me you'll be able to comfortably trade a small account and make a good result out of it. It is possible. Don't misquote me. It is possible, but it's going to take you time to do. It's going to take you time to do, because if you are trading a $50 account and you want to make do with a setup of 100 pips, it means that you'll be trading with 0.01. How long are you going to trade with 0.01 to make ends meet? You'll be tired out of the job, and before you know what is happening, you will get out. You just lose focus. Because when you are trading and you keep trading, and you are not making anything out of it, you tend to lose hope. And some people will even think that Forex is fake. Forex is fake. I don't mind them. It's fake. There's nothing there. It is you that do not know what you are doing. This is how you trade a small account. That is why you see me, I will tell you, I'm trading this $30 account, and at the end of the month, I want it to be $1,000. Okay? From $30 to $1,000. Some people say, how possible it is? It is not possible. This and that. It is possible. And all I do every day is what I have just shown you. Now, the final thing I will tell you before I entertain questions from you is that this particular strategy I have taught you is not just deployed to trade a small account. You can also use a similar strategy for your big account. Oh yes, you can. You can use it for your big account and it will gel. All right? What you are required to do first and foremost is to be able to depict what the market is doing. Have the right setup. That's number 1. Number 2, time your entry. When I say time your entry, do not go and click buy or sell when market is almost closing. When maybe New York session is almost closing, or London session is almost closing, or in New York session, where you know that liquidity rate, when you know that consolidation is usually the order of the day. Why should you go and press buy and sell those times? So you have to wait after you have seen your setup. If that setup is right and you are not in London session or you are not in New York session, please do not take it. If you know that you want to maintain a very tight stop, do not take it, please. Because the possibility of the setup failing is there. Is that okay now? So that is how you look at it. Not only getting a good setup, you must get a good setup. Number two, you must time your entry. When I say time your entry, wait for London or New York. And even when you are waiting for London session, I beg of you, please, do not enter, do not click the buy and sell as soon as London is opening. As soon as London open in the market, you notice a lot of flash up and flash down, flash up and flash down. That is not the right time to go into a trade where you want to maintain great risk to reward and you want to possibly maintain 10 pips stop loss, 10 to 15 pips stop loss. That is not the time, guys. You need to wait when the London session has settled. All right. You know, there are a lot of orders. The way you should look at this market as a market where interbanks are relating with each other. There are a lot of pending orders that are waiting for actions. And as soon as banks resume in Europe, all these orders will be keyed into the system. And as soon as these orders are being keyed into the system, you are going to have an immediate reaction in the market. So that's why you have the flash up and flash down, flash up and flash down. But if you are able to wait just an hour into London open, wait for just an hour, allow the market to settle. Let us be able to appropriately depict where the market is going. As soon as you have this information and you go to new session of Forex Factory to know if there are a piece of news that you can use to support your analysis. If you are able to get that and you see that it supports your analysis, you are good to go. 10, 15 pips, you maintain great risk to reward. And then you make sure that this trade setup you are taking, it has a similar directional bias in all time frames. What do I mean? It means you have analyzed this pair in weekly time frame. It is bullish. You step it down to daily time frame. It is bullish. You come to 4 hours. It is bullish. You come to 1 hour. It is bullish. You come to 15 minutes. It is bearish. So what is it telling you? You have to wait. Allow this 15 minutes that is bearish to turn bullish. Once it presents a bullish structure in 15 minutes, there is what is called a change of environment. All right? There's a change of environment from 15 minutes time frame that is agreeing with higher time frame directional bias. And that is the right time you pull the trigger. If you don't want your 10, 15 pips stop loss to be cut. Guys, this is how you trade small account, or this is how you want to maintain great risk to reward and have your account flip up in no distance time. Okay? So after you have done this, the next thing will now be management. How do you manage this trade in such a way that your profit is realized? 2 steps. Number 1, capital protection. Number 2, profit acquisition. How do you protect your capital? You protect your capital by a strategy we call break-even. And a break-even is a situation where you neither lose nor gain. The net profit is what? 0. All right? Remember, when you are breaking even, you must ensure that you have added the broker's commission. Add it, meaning that you break even like 2 pips into profit, so that whatever profit you get from these 2 pips will be able to cover for broker's commission. It is in that scenario that you are going to have a break-even trade. But if you break even at the exact price of your entry, you will discover that when you check your MT4 history session, you are going to see that you have a small red, and that little red will never have depicted a break-even trade. It's a loss trade because it's going to reduce your capital. Is that okay now? So at every point in time you want to break even, you must do it 2 pips or 3 pips into profit. Okay? So that is the capital protection aspect of account management. The next is now profit acquisition. How do you manage your profit? That's the one I taught you before, that when it pours away, after you have break even, when it pours away and you are seeing that the direction bias, the buy or the sell is very solid and very strong, very powerful, okay, and you have secured the first 2 positions, you can add 2 more positions. And at this stage, you are only risking your account on these 2 last positions. The first 2 positions, you are not risking anything on it. Okay? So that is how you go about it. Is that okay now? All right. So I want us to go and practicalize this approach, and I want everybody to give me minimum of 10 to 15% growth of his account in a week, applying the strategy I have just taught you. I need 10 to 15% account growth in a week, every week, and I need consistency. I need consistency. I don't want a station where you return a big profit this week and you return big loss last week. You will agree with me that we returned big profit last week, 50%. One account 50% growth, another one 28% growth, another one about 300% growth last week. And this week, all the trades we have taken, no loss, all profit. That is what it takes to be consistent in this business. All right? So go and practicalize this and give me a positive feedback. Is that okay now? Do we have any question? Do we have any question? If you have any question, you can unmute yourself and ask your question. I'm waiting. Hello?
Hello, Mr. Nat.
All right.
Thank you very much for the session, sir.
Okay, thank you.
So my question is, you said before you execute your trade,
yes,
you would wait for a slight correction, then an impulse.
Yeah,
so
okay.
I would like to know, what do you mean by impulse? Your own interpretation of impulse at that time, is it a bullish engulfing candle, bearish engulfing candle? So can I have that sniper entry you're talking about?
Okay. Thank you. Now, let me go and show you example of what I'm talking about. Let's go to USD card. First, let's clean all this. Let's go to USD card. I will show you example of what I'm talking about. USD card. Can you see USD card? If you remember in my weekly outlook, if you watch, I made it clear that what we want for USD card is this to give us a retracement level of 50% or 61.8%. And as soon as we get 50% or 61.8% retracement, we are going to be buying USD card to the upside. I don't know if you watch the video. We are going to be buying it to the upside. Okay? Now, where are we? This is 50% retracement. Guys, this is what? 50% retracement. It has gotten to that level. There are many trades I don't send out to the group, even including my VIP group. Why? If I have given the condition to have that trade in a video or in a training, what is the point me sending it to you again? I've already told you. All right? So now, what we expect is a 50% retracement for us to be able to take the trade. And this is a zigzag corrective structure, ABC. So for zigzag, complete. All right? Zigzag, complete. Okay? And after zigzag is complete, retracement level, 58%, complete. And let me give you another thing. Do you see this level? See that there's consolidation there? What does this consolidation mean here? There was order accumulation. Order. This setup, this pair, accumulated orders here. And can you see? Breakout to the upside. So when it got to the same level, the same thing might want to repeat itself, and then it pick order, boom, to the upside. So as soon as you have this, when this happens, I want to take it as a retracement. And then immediately I saw this bullish candle here, I know that we may not be coming downside, especially now that we are close to New York. We are close to New York. And I know that USD card is a New York pair. It's a New York pair. It's a pair that moves in New York session. That's what I mean. So if I'm having a setup of a pair that moves in New York session, and I'm having that setup like this, and the market, even though it's a bearish market, but at the moment, it has to necessarily go bullish to complete a corrective structure. So what do? I pull the trigger. I had pulled the trigger of this market right from here. I pull the trigger right from here. Why? Because I know what I'm doing. It is risk-free right now. Even if the market decides to give us this structure one more downside, I lose nothing, guys. I lose nothing, because it is risk-free. But if I have this impulsive move away, what do? I break even here. I just move my stop to this level. And if I have a small consolidation here, I know we are going to the upside. I add another 2 positions. 2 solid positions, meaning that this small trade, I'm having 4 positions running. And then when you see the MT4 all are in blue, you think I've just entered 4 positions at the same time. No way. I did not enter it at the same time. 2 positions first or 3 positions first, it impulses away, I secure it, I wait for another opportunity, 2 or 3 positions again, then off it goes. Because we know that we cannot come to this level and come down again. There is no structure like that. We already have this move, okay? And then we have this retracement up to 50% level. And then what are we expecting again, guys? We're expecting a move to the upside, at least to break this top, because before we can expect anything to happen. Otherwise, do you get it again? Do you get it now? So when I say impulse, I just mean a bullish move or a bearish move, as the case may be. That's how to approach it. Are you clear now?
Oh, yes, thank you very much.
Oh, okay. So any other question? Any other question?
Okay, I have one question, please.
Okay.
How far back do you go before you look at a new trade for the new day in terms of back testing?
When I'm back testing, how far back do I go?
If we want to look at New York for today, for example.
Okay.
And do I only look at yesterday's trading or go how far backward should we go?
Okay, okay.
To be able to know what's going to happen this morning for New York trade.
Oh, okay. All right. Now, going back to what happened yesterday, as far as I'm concerned, is inconsequential to what will happen today. The fundamental that drove the market yesterday might not repeat itself today. So what is the point looking at what happened yesterday? What interests us is the chart that is before us. What do I mean? Let's use USD CAD as an example. You have this move, it's an impulse. You have this move, it's a correction. What are you expecting? You're expecting this. Is that okay? Now, if you know that this is what you are expecting next, when this market was here, let me break it. Let me cut it out so that we can understand. Okay? Okay, I think I can't do that. Okay, I can't do that. Okay, let's see. When this market was here, can you see my cursor?
Yeah.
When it was here, could anybody in his right senses, could he have taken this buy when it was here? Could he have bought, could he or she have bought USD CAD? No, because I told you in my previous video that I will never buy or sell when I have retracement level of 38%. It's too shallow to my liking. Can you see example? Can you see the reason why I told you that? Now, take your fib from here to here. What is this level? 38% retracement. Some people want to buy this piece. And what did I say? I said, never buy a single impulse correction. A single impulse correction is not a corrective structure, it is a mere pullback. And there is difference between a pullback and correction. A correction can only qualify, a pullback can only qualify as a correction if it is in a three-wave structure. So now, let me make it clear to you. You can see from here that after we have this move, it is 38%. I said nothing should make us to do this buy because we know this is coming. This is coming to make 50%.
Right.
If this market should come down like this, all right, we are pardoned. We are pardoned for losing it. That is, if you do not place your stop loss here, you want to maintain a tight stop loss and you are taking out, you are pardoned because you have waited for the right size of correction before you entered. There is what is called right look in corrective structure. Does your corrective structure have the right look compared to the impulse? Now, if you look at this impulsive move of USD CAD in 1 hour and the corrective move of USD CAD in 1 hour, you will agree with me that they are proportionate. So you want to see the adjustment and the balancing and the proportionality of your impulse and correction before you decide whether this market will certainly move to the upside or will retrace. There are setups I will tell you that this setup will never retrace. It will never retrace. You will ask me, what is giving me this confidence that it will never retrace? I told you yesterday when I gave you those two trades, I said these two trades will not retrace at this level. They will not retrace. Why? Because I have balanced them up. I have seen the proportionality in the impulse and the correction. And I saw that at this level of correction, there is no need for a further downside in corrective structure. I have gotten a 61.8% retracement, and the continuation is having a bullish and powerful move. Then what should warrant a further move to the downside? And I have waited for New York session to start, where I know there is adequate liquidity for the upside. And that particular pair in question, for instance, is a New York pair. So what are we talking about? if you are trading a New York pair and you are having a bearish setup and you wait for New York to open, you see the liquidity and you see the setup playing out, you pull the trigger. That is why I said you put in more work into your trading and less action. Look at it. We have been monitoring this USD card since on a Friday after we had this. We have been monitoring it. That is more work. We are doing planning, a lot of planning. When it came down like this, we were monitoring. When it went up, we were monitoring. When it came down, we are monitoring. Now, this is the right time to pull the trigger. So when you pull the trigger, expecting it to go all the way, you have only spent 3 minutes in pushing the buy button. 3 minutes, whereas you have been planning it since last week. Then you see some people, they just open their MT4, they open their trading view, they click USD JPY, they say, USD JPY, okay, it's a sell. Click sell, bam. You have done less work in planning, small work in action, you produce massive failure in your result. Abysmal failure in your result because less planning has gone into it. Is that okay now? So you must wait to see the proportionality of your impulse and correction and ensure that that adjustment is balanced enough and you see a reaction. You see a reaction from the market to depict your directional bias before you now go in for buy or for sell. You can agree with me that this USD card now is getting ready gradually for New York. You can see it's not comfortable. It's waiting for New York to open in less than an hour. So if New York open and we see this market first pull to the downside, do not panic. Wait. At a certain point here, I expect it to move to the upside. And it could as well start moving at this point in time to the upside. So that is it. But if this setup that is forming in Asian session, don't even bother to take it. Why? There's no liquidity to drive it. There's no volume in the market to drive it. So even if it goes to this level, be sure that when London resumes, it will come down again. So these are things that must be known in trading, that I always refer to. Trading is much more than to click buy and sell. All right? Have I answered your question well?
You have.
Good.
Thank you very much.
Good. Another question? Another question? No more question. So, have a great day, everybody. Let's end the session here. I don't want to make it too long. We have already spent more than an hour. Let's have it again tomorrow. God bless you all. Bye.
Grateful, sir. Thank you, sir.
Yeah.
Thank you, sir. Bye.
Yeah.
Thank you.
Thank you, sir.
Right.